Look, it is early in 2024. And if you're like me, Christmas is over, holidays are done. We did probably spend a little bit of our income on credit cards, and now we're getting these in the mail, and we got to do something with them, right? So we're not expecting, or we're not really wanting a lot of credit card debt, or 2023 was a little tough for a lot of people, and we might have gotten behind because the cost of goods, well, they went up. Gas, food, everything. And sometimes there's too much month at the end of our money.
So true.
So how do we deal with that? Well, at Be My Neighbor Mortgage, I want to spend a few minutes with you just to talk about debt consolidation, if it's a good idea or a bad idea for you, and why.
Credit card debt, credit card debt, credit card debt.
So let's walk through the steps, and I want to hit some of the scenarios. And then if you get through this video and you're like, you know what? He didn't talk about my particular situation or scenario, please just drop a comment there. Let's talk about it. Let's chat through what you're thinking, because there are different ways to skin this entire problem. And I want to share some personal anecdotes and some experiences with you that I think will help. Because when there's too much month at the end of your money, well, hope tends to dwindle. It gets really hard. Financial hits are difficult. So I'm talking to homeowners today. Homeowners, you are sitting on possibly, more than likely, some equity. If you've owned your home for over 12 months, you are probably sitting on an equity position. Maybe not a great one, but there might be some. Now, if you've had your home since the last, say 2021, 2022, in most areas of the United States, you are sitting on equity, even if you bought it at a pretty high loan to value at the time. So let me share some for instances. So for instance, in 2021, I did buy a property that I currently live in, and I put 10% down. And I locked in an interest rate of 2.9%. And I really do not want to hit that interest rate because I like it. I like the payment. I like where I'm at. And even though taxes have gone up because valuations have increased, it's still affordable for me and my family. That's a really big key importance. But like everybody else, I drive a vehicle with two teenage kids back and forth everywhere from everywhere in town.
Taxi, taxi.
And we spent more on gas. We're spending more on food. We've got braces. We've got maintenance to the property, maintenance to the house. There's costs have hit us that were unexpected. And while we had some savings, it still hurts. Also in 2023, there were, for many of us, we may have kept a job, but we faced income shortages, downfall, even some restrictions in what we thought we were going to earn, or lack of bonuses, etc. So we plan as humans a lot on what we're expecting to happen in the future and what actually does happen. Now, if that's you, if anything like that has happened to you or happened with you, you may start wondering, well, what exactly can we do, or how do we manage that to ensure that going forward, things are affordable? So credit card debt can be really, really devastating because you're looking at interest rates. In fact, I hopped on Forbes just 4 days ago. They talked about what is the average credit card interest rate today in America. Do you know it's 22.75%? 22%. 22.75% is the average assessed interest rate on credit cards. That's a lot of money. So for every $100 that is a balance, $22 is charged in interest. Like, let that just sit for a second. How in the world are you supposed to catch up if you have credit card debt with that type of interest? And if you go and say, well, hey, my credit score is over 700, I pay off my balances regularly, but I just had to carry a balance for a while, guess what? They're facing the same economic impact. And I mean the credit companies, credit industries, everybody. They are not necessarily in the place to reduce the interest rate because the Fed has increased the bank borrowing rate and they are still affected by that. So even if you're like, I'm a great borrower, they should lower my interest rate. They may want to as humans, but they may not be able to do it from an economic standpoint. Okay, so where do we find relief? Most homes, like I was starting with, have some equity position now. Equity can be accessed in a few different ways, right? So you've got home equity line of credit or a home equity loan. Both are similar but a little different, or a total refinance of your mortgage. Now, for me, at 2.9%, I don't want to refinance the entire thing. I like that. But I do have equity. My valuation has gone up. So for that instance, I'm looking at something to do similar to a home equity line of credit. That's where I'm going to go to a bank. I'm going to say, hey, I have, I don't know, another $50,000 worth of equity in my property. And the way you calculate that is this. You take your expected equity or your expected value on the property. So say it's $500,000. Okay. And you subtract 20% of that. So at 500,000, 20% is $100,000. And so that means that at $400,000, 400,000 is 80% of the value of my current home. Now, if my current loan is below that $400 threshold, $400,000, I more than likely have some room of equity that I can borrow from in a home equity line of credit. Now, there's differences. Not all banks do 80%, some do 75%. You have to shop around. But that's when we talk about equity, that's what you're trying to look for. Now, I went out and said, I don't want to pay 22% on credit cards. I did have to charge some stuff up this year. I had to replace the transmission in the truck. I had to fix my plumbing. I had the braces thing, right? So I've got some things that I really don't want to pay 22% on anymore, but I didn't have the cash at the time. So I go to a bank and I say, hey, bank, what do you have as far as a home equity line of credit? That's where I'm going to consolidate my debt. I'm going to take that debt at higher interest rates and bring it into something smaller. And that bank offered a home equity line of credit at 2 years, interest only payment at 6.9%. And then after that, it adjusts to the bank rate, not to exceed 14%. Now, 14% is still much better than 22%. So every $100 borrowed is $14 in interest versus credit card, which is $100 and $22 borrowed in interest. So for me, the consolidation made sense. I could take that, I'm going to say $30,000 and bring it in and cover that with a lower required payment than my credit card. But what I'm doing is I'm saying, okay, for that lower required payment, I'm still paying the greater amount that the credit card charged me because I knew like my budget was built that way. I'll pay that debt off much, much faster. That is, in simplest terms, a debt consolidation plan. You take lots of debts you have over here, you find a better debt vehicle, like a home equity line of credit or home equity loan, and you put it all together, kind of bundle it up under one interest rate that is lower.
Okay. Sounds good.
All right, so doing a refinance loan to consolidate your debt may sound like a great idea, but how do you actually make the decision? Let's talk about blended rates. So a blended rate is when you literally take the credit and the interest you're paying now on the debt, and you basically do a math problem and say, okay, well, this is how much debt I have, and this is my average or consolidated blended rate. How much does that interest rate look like? Simple math. I like using Dr. Calculator. I also really like using calculator.net. Recommend both of those for you because really they're not asking you to fill out a lead funnel to sell your information. They're just like, hey, you need a calculator? Check this out. So let's do a blended calculator here real quick. We're going to say, okay, our first balance is at $10,000 and say you owe that to a credit card at 23%. And then you've got maybe another 25,000. That'd be a lot, but somewhere so there. Let's say 9,000. You owe Amazon, and Amazon's charging you 18%. And maybe let's just start with we got hit with another little bill, and so we went to Home Depot, got ourselves a $2,500 debt, and they're charging us 25%. Okay, let's calculate that. So it averages up or calculates up my total here, and then it averages my blended rate. So the effective rate, only if correct if all loans are paid off for the same time period. But what it's doing is it's giving me a line. It's giving me basically a yes or no spot. Now, simply put, I can take this balance and this blended rate, and I can go to a payment calculator and say, okay, I had a grand total of $21,500 at a rate of 21.14. So let's say 21,500 and I don't know, pay it off in 10 years, 21.15. Let's calculate that to round it up a little bit. If we go there, what it's telling us is like, look, your interest monthly, $378.94, your principal, $53.09. Every payment goes down until you finally pay it off at the end of 10 years. This is doing a simple amortization of interest payoff. This is just a baseline loan. So what if we did that same loan, but we consolidated it with a HELOC or a full refinance? And let's just say we were able to lock that interest rate in for 7% and still pay it off over 10 years. What does that do to our payment? Because payment is where affordability meets debt. I really have to know if I have enough money every month to pay off the obligation of my debt. All right, so let's just change one thing here. Same balance, 10 years, we're going to pay it off, make it 7% interest flat. What does that do to my payment and my payoff? I'm going to go monthly schedule again because that's what we're dealing with. Now, every month I'm actually paying a higher amount to my principal and a lower amount to my interest. Pretty remarkable, right? I'm still at $250 instead of, you remember what we were at the one before? $430. So I'm saving myself money every single month, real close to half, not exactly half, but real close. And I'm paying it off in 10 years. So what happens then if I turn around and make fixed payments on that and pay it off faster? Like what if I put $400 to this? That means that the interest would still be $125 for this first month, but the principal payoff would be another $120 some dollars. Doing quick head math, so I might be wrong. What does that look like? It means that actually I would pay the loan off so much faster because I'd be paying down the principal, so the interest amount would shrink while the principal amount grows every time it's paid off. It's a better financial decision, even though I'm taking a higher interest rate than my current mortgage. It makes more sense to pay it off faster.
Yeah, that makes sense.
When it gets down to debt consolidation, there are so many things we have to consider. You need to. It's a personal decision, okay? Maybe you have more money available to you if you were tighten your budget in certain areas. You could pay off your loans at current credit card rates faster, okay? Debt consolidation is not always the right decision, but it is a tool. Finance and debt, they are not bad words. They are tools to use. Hammers, screwdrivers, right? Nail guns and power staplers. They're all beneficial for the right goal. If you're trying to achieve or build something specifically, you want to use the tools, but they have to be used in the right manner. You don't use a screwdriver to try to drive a nail. It just doesn't work right. Okay, so think about the tools available to you, and that's what we want to utilize to help you make good decisions, because the mortgage, your house, your real estate is generational wealth. So you want to manage it well while not getting yourself into trouble financially where you can't pay your bills and you might risk losing it all. So don't be precious about the interest rates. Don't be precious about the payments. Be precious about your family, your budget. Understand that access to debt is actually a benefit to making wealth in the future when used wisely. If you find yourself in that position where these bills are coming due, they're coming in and you're not looking forward to them, not exactly sure what to do with it, let us know. I'd be happy to walk through your scenario and help teach you the different options that you have available to you, just like somebody helped me when I was early on in my marriage and my home ownership. So it allows me to make some good financial decisions in the future. That's what Be My Neighbor Mortgage is all about. And if you listen this far, I thank you for your attention, and I hope that you will find value in this. And if we can help you with anything else, let us know. Have a great day.